The game bubble has really burst? Was there really a bubble? EA shares just plunged 19%, marking their worst day since the dot-com bubble. Sony shares followed suit, reacting to Electronic Arts cutting its guidance. And here's a shocking stat. 1 in 10 game developers lost their jobs in 2024 alone. And what's going on? Is it still worth investing in the gaming market? Let's break it down in this video. But before we dive in, don't forget to like and subscribe. It really helps us keep creating this content. And first of all, what's a bubble? Imagine there's a new toy everyone wants. Let's say a super cool limited edition skateboard. At first, it costs $100, which seems fair, but then people start saying, this skateboard is amazing. Everyone's buying it. It's going to be worth so much more. So more people rush to buy it, thinking they can sell it later for a higher price. This drives the price up to $200, then $500, and eventually even $1,000. But here's the catch. The skateboard didn't actually get any better. It's still the same skateboard. The price is just being hyped up. And eventually someone realizes, wait, this isn't worth $1,000. It's just a skateboard. And more people start thinking the same thing. And suddenly no one wants to buy it anymore. The price crashes back to $100 or even lower. And that's the pop of the bubble. In the financial markets, this happens when people hype up a stock, cryptocurrency, or investment, pushing its price way higher than it's actually worth. When reality hits and excitement dies down, prices fall, and those who bought it in at the top lose money. That's why it's called a bubble. It inflates, then bursts. And second, why do people think we are in a gaming bubble in the financial market? Well, let's break down the state of the gaming industry by looking at 3 major players: Ubisoft, Sony, and EA. Each of these companies reveals a different piece of the bigger picture about what's happening in the market right now. Ubisoft has been struggling. In the first half of their 2024 and 2025 fiscal year, their sales dropped nearly 20%, falling to 672 million euros compared to the same period last year. Their net bookings, which represent future sales potential, fell by 22%, landing at 642 million. While some of their games like Star Wars Outlaws received solid reviews, the sales didn't match expectations. To make matters worse, the delay of Assassin's Creed Shadows by 3 months caused their stock price to drop by 70%. These challenges have pushed Ubisoft to consider major changes, including restructuring or even selling parts of the company. Sony, on the other hand, has been a dominant force in gaming, but even they have hit some challenges. Their stock has been under pressure recently, and there are several reasons for that. About 20% of Sony's gaming software revenues comes from EA titles, and EA's recent decision to cut its financial forecasts raised concerns about Sony's bottom line. Additionally, Sony announced plans to stop producing physical media like recordable Blu-ray discs and mini discs by February 2025. While this move aligns with the shift to digital, it upset collectors and made some investors uneasy. Sony also faced setbacks with their projects like their live-serve game Concord, which failed to gain traction after launch. Despite these cracks, their gaming division remains a powerhouse, bringing in 3,644 billion yens in revenue last year, an increase from 2,739 billion yens the year before. EA is facing its own struggles. The company recently revised its financial outlook downward, reducing its expected net bookings for 2025 from 7.5 to 7.8 billion to 7 to 7.15 billion. The reasons? Their EA Sports FC25 series didn't meet sales expectations, and the Dragon Age franchise underperformed. Following this announcement, EA's stock took a significant hit, signaling deeper concerns about their ability to deliver consistent results. Now, let's step back and look at the bigger picture. The gaming industry is in a strange place. For players, it might be one of the best times in history. There is an incredible variety of games, consoles, and subscription services like Xbox Game Pass and PlayStation Plus that make gaming more accessible than ever. But for the industry itself, things look tough. More than 30 game studios have shut down recently, including Arcane Austin, Volition, and Firewalk Studios. Budgets for AAA games have spiraled out of control, and 5 years ago, projects cost $50 to $150 million to develop. Now, $200 million is the starting point, with some games like Call of Duty costing $300 million. One unnamed franchise reportedly hit $1.2 billion when marketing was included. If these massive projects don't succeed immediately, they're scrapped. Recent examples include Sega's Hyenas and Blizzard's Odyssey, both cancelled because publishers didn't believe they'd generate enough profit. And at the same time, indie games are thriving. Smaller, more focused projects like Animal Well and the Crimson Diamond are gaining popularity among players who want simpler, more meaningful experiences. These games prove that success doesn't always require massive budgets or open-world designs. So, has the AAA bubble burst? Not quite, but it's definitely deflating. The industry is at a crossroads. Publishers must decide whether to keep chasing bigger, riskier projects or shift their focus to smaller, creative games that prioritize fun and innovation. Now, let's talk about the companies that don't come up when rumors of a gaming bubble arise. Tencent, Microsoft, and Nintendo. These three are among the biggest players in the market, and they're worth examining. Tencent, despite losing billions in market value after US accusations of ties to China's military, continues to grow. In November 2024, Tencent's profit jumped 47%, driven by strong video game growth in China. Microsoft, on the other hand, doesn't need much explanation. As one of the largest companies in the world, gaming is just one piece of its massive portfolio. Even if gaming underperforms, other parts of the business easily make up for it. Microsoft's diversification gives it a resilience that's hard to match. And Nintendo, in contrast, is far less diversified and focused almost entirely on gaming. But that focus has paid off. Just a week after the review of the Switch 2, Nintendo's stock in Japan hit an all-time high. So where does this leave us? This gaming industry is changing rapidly, and while players are benefiting from an abundance of choices, some companies are navigating one of the toughest periods in recent history, but others are growing and expanding. So there is no bubble, just what has always happened in the market. The best deals prevail. So let's move on. The question is it worth investing in games? And what does this mean for you as an investor? I always say that investing in crisis can be a good thing because you can get some promotions, but that's not always true. How do you know if the price is fair? That's where the Benjamin Graham formula comes in. This formula helps you figure out how much a stock is really worth, kind of like checking if something is overpriced or a great deal. It looks at three things: how much money the company makes per share, called EPS or earnings per share, how the company is expected to grow in the future, and the current interest rates for super safe investments like corporate bonds. Here's the formula. Intrinsic value equals EPS times 8.5 plus 2 times growth rate times 4.4 divided by current bond yield. Now let's break it down using Sony, for example. Here's what we know. Sony's earnings per share are 1.18. Analysts think Sony's earnings will grow by 8.97% per year. The current interest rate for those safe bonds is 4.62%. If we plug those numbers into the formula, it says Sony's intrinsic value is about 29.71 per share. Now let's compare that to Sony's current stock price. Right now, Sony is trading at $22.26. But don't just take this as a signal to buy immediately. This is where research, conviction, and risk tolerance come into play. So what would I do now? I would add Sony to a watch list and wait for a confirmation, either earnings improvements or a clearer macro recovery. If you believe in Sony's long-term future and its diversified revenue streams, you're not just investing in today, you're betting on its entertainment empire of tomorrow. Now let's take a look at Electronic Arts, the EA, using the same formula. Here's what we know about EA's current numbers. EA's earnings per share is 3.90. Expected growth rate for the 5-year CAGR is 0.83%. So according to this formula, EA's intrinsic value is about $37.74 per share. Now compare that to EA's current stock price. Right now, EA is trading at $118.46, which is way above its intrinsic value. This suggests that EA is overvalued according to the Benjamin Graham formula. Does that mean EA is a bad investment? Not necessarily. Like Sony, EA is a strong company with a solid lineup of games that bring in consistent revenue. However, its growth rate is much smaller right now, which impacts its value based on the formula. If you're looking for a bear game, EA also doesn't seem to fit the bill. And Ubisoft, well, now, unlike Sony and EA, Ubisoft is a French company, so it's not traded in the US market. But that doesn't mean we can't apply the same principles here. To calculate its intrinsic value, we'll use the Benjamin Graham formula again. Here's what we know about Ubisoft's numbers. Ubisoft's earnings per share is negative, sitting at minus 0.42. Its 5-year compound annual growth rate, the CAGR, is also negative at minus 30.37%. Meanwhile, French treasury bonds are paying about 3.5%. The intrinsic value for Ubisoft, based on the formula, comes out to be approximately 27.58 euros per share. But here's the catch. Even with an 11.20 market price, with a negative EPS and a declining growth rate, this result doesn't paint a clear or reliable picture. The Benjamin Graham formula works best for companies with positive earnings and growth. Negative numbers like Ubisoft's can make the calculation less meaningful. And what does this tell us? It's a sign that Ubisoft is in financial trouble. And when a company is struggling, it's crucial to look beyond formulas and dive deeper into its fundamentals before making an investment decision. So, while the formula gives us a number, remember, context matters. Formulas like this are tools, not gospel. Use them as a starting point, not the final word. The moral of this entire video is don't follow the headlines. Don't follow the rumors. Think with information and don't believe bubble rumors if they don't make sense. Stay tuned and follow who really brings facts and data to the table. Bye-bye.